Hello viewers, this is Dr. Alok Chajed on Already Late, your favorite channel for simplified learning about the complexities of the world of finance and economy. In my previous video, I had discussed about the low returns in liquid funds and other debt funds. If you have watched that video, you will appreciate the fact that interest rates are likely to rise in the near future. If you have not watched that video, I suggest you watch that video first by clicking on the link on the screen. Investing in debentures carry three significant risks: credit risk, liquidity risk, and interest rate risk. Credit risk is the likelihood that the issuer of the debenture will default on repayments. Liquidity risk is the risk of not being able to withdraw your money when you need it. Interest rate risk is the risk of changes in the market price of the debentures due to change in interest rates in the country. So, what exactly is a floating rate fund? Floating rate fund is a fund which invests a minimum of 65% of your investment in floating rate bonds. So what are floating rate bonds? In a regular bond investment, you receive a fixed interest payment on regular intervals as long as you own that bond. In a floating rate bond, the interest rate that you receive, the interest amount that you receive is not fixed. They are linked to a benchmark rate like repo rate or government security rate or MIBOR, which is Mumbai Interbank Offer Rate. As the benchmark rate changes, the interest that you will receive also change. If benchmark rate increases, you get higher returns, and if benchmark rate reduces, you get lower returns. A recent example of floating rate bond is the RBI floating rate bond, which is currently offering 7.15%. This interest of 7.15% is not a fixed rate of interest. What RBI says is it will give you 0.35% above the rate of NSE, the National Savings Certificate. The current rate of NSE is 6.8%. Now let's say NSE rate goes to 6.5% from 6.8. So your RBI floating rate bond will now earn 6.85, which is 6.5 plus 0.35, which is 6.85, and not 7.15%. Having understood what floating rate funds are, the next question is why floating rate funds look a good investment in the current market scenario. Now, as you know, the current rate of interest on debentures is very low. This means that if you invest in a debenture today, you will receive this lower interest on your debenture for the entire future. And in all likelihood, interest rates seem to have bottomed out currently, and it should be moving higher in the next few months. This means that the new bonds issued later will earn higher interest rates, thereby making the current bonds, the bonds which you buy now, look less attractive. It's like investing in a FD now, and when interest rate increases, your FD will still give you the lower interest rates. The new FDs will give you higher interest rates. So if you invest in a floating rate bond, your interest rate will also increase just like how the benchmark rates increase. So what will happen is you will get higher returns. So in this scenario, investing in regular debt funds might lead to lower returns or sometimes even negative returns in the near future. But if you invest in floating rate funds, you do not face this risk. As and when interest rates go up, the floating rate bonds will adjust their coupons upwards, and hence the fund will make more coupons and will not have the interest rate risk. To put it in a single sentence, whenever interest rates go up, these funds will earn higher coupons and hence will not have the risk of lower bond prices. So should you invest in floating rate funds? The obvious answer is yes, you should. But you need to take care of a couple of things before investing. First, while investing in floating rate funds, have an investment horizon of a year or more. And second, spare some time to look at the portfolio of the fund that you are investing in. Ensure highest exposure in the fund is to debentures with investment grade, which is AA and above. If you want to know which floating rate funds are good for you, do leave a comment and I will definitely get back to you. Please do not forget to like and share this video, and do not forget to subscribe to the channel if you have not done it yet, and please press the bell icon to receive timely notifications. Happy learning. Thank you.